And the subject today is going to be how to manage the capacity of your Darwin. This webinar is primarily aimed at Darwin providers, not so much at Darwin investors. However, there are interesting takeaways if you're on the other side of the fence, as many of our traders are, because as I'm not sure you know, but actually 60 to 70% of users with a trading account also hold an investing account, which has been one of the interesting takeaways from building Darwin. We would have never suspected that when we first got going. This webinar is slightly technical and it touches on topics where I have probably had a lot more exposure than an average trader, and maybe because I'm too deep in the subject, I will take stuff for granted which cannot or should not be taken for granted. So please, 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 if there's anything that I say which doesn't make sense or it's not obviously understood, please let me know and I will do my very best to explain there and then. And my apologies ahead of time. Okay. So what is the agenda for today? We will have a very quick reminder on the Darwin order replica process, so you understand how investor trades are clear in the market after the trades submit their lead trade. Then we'll have to explain some stuff about over-the-counter foreign exchange or forex market, how it works, and how liquidity is aggregated, because ultimately that's how liquidity is what takes care of the capacity of your Darwin. I will give you some practical advice on easy to implement measures to optimize typically algorithmic trading, and then also share some ingoing thoughts on the Darwin-X roadmap when it comes to managing capacity. And I'm saying this 2 months after we had to shut down for new investment the first Darwin, and then about a couple of weeks after we had to shut down the second, which is a great thing, but ultimately is going to be a challenge to manage, in the sense that success at Darwin-X implies shutting down the Darwins, and that's actually a good thing from the trader standpoint. Okay, so if you need or want more background on some of the topics that I'll touch upon today, I've put in these YouTube references from previous webinars that we've held. So one on explaining the divergence with this URL that you can check in our YouTube channel. Another one on liquidity aggregation, again with the same with another URL. And also to give you some context, the blog post that we wrote when the first Darwin THA was first paused for new investment. I encourage you to make a note of those, because I think whatever you see here and whatever you see there will probably make more sense once you've understood today's discussion. So without further ado, let's get going with the Darwin investor replica process. And, not to beat around the bush, what happens is at time 0 here, which is the bottom line on this axis, Darwin trader places a trade, say, in the euro dollar, and then our risk management engine comes in to compute the total amount that all investors in that Darwin will send in combined to the market. That process takes typically, it takes very short from a technical standpoint, but there are some processes we haven't really optimized that make up a total latency of up to something like 100 milliseconds. And then we send the block order for all investors after the trader has been filled, and get back the confirmation from the last leg of the trade, which is what you would see here. So a dot here would tell you that the block investor trade with a size proportional to the area of the trade was filled, in this case, with 0.4 pips of positive divergence, i.e. the fill for the trader, for the investor, was 0.4 pips better than it was for the trader. And the trade was completely filled something like 100 milliseconds, as you can see here, after the trader. Okay, so if you're not familiar with this bit, you can find it, let's just go for on any given Darwin. When you go in there, you go to the Divergence tab, and at the bottom you would see the plot that we're seeing. Notice that in some cases the latency is typically well below 0.4 seconds for most trades, as you can see here. In some other cases, typically traders that trade in less liquid conditions, for instance, say DHA, you'll see that, well, typically the dots tend to be larger in this case because it's sending bigger orders. And also there is that tendency to take a bit longer to fill in this particular case. And in some cases you see some pretty negative divergence. Okay, so it varies across Darwin providers, but ultimately there is two elements at play here that we shall discuss in a second. We'll come back to the subject of fill times later today, but for now, let's just try and go back to the two components of divergence. So divergence is the combined effect of this replication latency, this delay, whereby the investors get filled after the trader has been filled, but also ultimately it's the slippage. It's eating into the market liquidity, which is not infinite. So the impact of latency in normal circumstances would be random if people didn't trade for the trend. However, most trading strategies, and this is something I learned also after a while of operating DarwinX and hearing from other providers, most strategies tend to enter in a trend. So you tend to buy the buying market and you tend to sell the losing market. And as a result of that, any delay in filling after the trader has bought the rising market or sold the falling market is bound to introduce a bit of a negative slippage here, but it's very, very minor. I mean, it's a very small amount. That's more like of a theoretical interest. When it comes to actual slippage, you do get the Darwin divergence because the investors tend to trade in larger size, and that's kind of the natural law of market economics. And also, in some cases, when you talk about providers who offer the EA or PAM in multiple brokers, what happens here is that we get hit with a double whammy because there's a bit of delay in sending the trade after the trader has placed it, and therefore the liquidity has already been depleted by brokers who jump the queue ahead of us when that happens. So because of that, because of the combined effect of those two, slippage will only detract from investor performance. So it's going to happen. Apologies because this text shouldn't be here. Now, most of what we'll discuss today pivots around the issue with slippage, because as we're already working on solving the latency issue in a way such that traders and investors eventually, whenever all is said and done, when traders and investors actually trade at the same time. So the latency is something which will be gone hopefully this time next year. Okay, so that's why we'll only focus on the slippage. Okay, so there's a question here around, since THA manages their own fund now, does that mean we THA investors will get more divergence? No, I wouldn't expect so, because what I think THA is doing, but that's a question for them, is that they're shutting down the PAM accounts. So the THA divergence, I think, will get better as a result of that, because they're centralizing the divergence here. Either way, what we're talking about is a negative externality. So a negative externality is what happens when you basically try and buy something and for whatever reasons, the conditions you get are not the conditions you expect. And typically this happens as a result of overcrowding. So in this case, you must think of slippage as the financial markets equivalent of the law of gravity on Earth. So there are ways to try and delay the point from which slippage hits, but ultimately the price you pay for success is getting slipped. So much as we like it, once a Darwin attracts more investor interest than it has capacity for, then that Darwin has come full circle, and you should expect that it's going to be part of the day-to-day running of DarwinX. Whenever more and more successful traders come, there'll be a race to get first into the good ones, because they'll fill up before they're shut down. Okay, so you must think of it as a traffic congestion, because all the investors in a Darwin are hitting limited liquidity at the same time. That's what happens. And in the case of, say, THA, because it's a strategy that trades in the news and it's pretty sensitive to to time delays, it's going to be hit harder than other structurally more liquid strategies. And this is neither good nor bad. It is what it is. Okay. However, you should note, and this is one key to what we'll be thinking of going forward, is that saturation. So this traffic jam is not necessarily structural. So if you can get people to queue in an orderly fashion, and instead of blocking things by bombing the liquidity on any given point in time, and instead breaking it up into smaller chunks, then you can basically regulate the traffic. So ultimately, yes, you will be hit by capacity, but the biggest hedge funds in the world actually have quant trading strategies, which are actually strategies that managed to place the most volume in the market at the least possible slippage by optimizing execution. And that's basically the game that Darwinx and its traders are about to enter. Up to now, this was just about proving that there are THAs out there. Now that we know that there's THAs and VTJs and GTDs and all the rest of good Darwins, it's about starting to play like a hedge fund. And we'll jointly make that journey. Okay, I'll come back to this one later, but keep that note. The issue of slippage is largely created because everybody is trying to hit liquidity at the very same time. If liquidity did hit the market slightly later in a fraction way, then we could greatly diminish the impact of slippage. So, as I said, it's ultimately the price of success. The markets approach efficiency through size. The only way whereby a strategy stops making money is because it gets so big that it moves the pond as it swims. That's the law of gravity that I alluded to. And there's no, you can delay it, but you cannot prevent it. Okay, with that, I think I've said enough on the subject of liquidity aggregation and of the inevitability of slippage. Are there any points that I've made up to now which weren't clear, or you disagree with, or you would want some color on before we move on? It's important that you place whatever questions on this now, because if you don't, we're going to be talking past each other for the remainder of the webinar. Okay, sounds like we're good. By the way, I love it when you guys say, yeah, understood. It makes you feel good. Okay, so on the next point of slippage. Now, I'm going to make some points, but before anybody draws any rash conclusions here, you should know that the top of book that we stream on our MT4 is good for 10 lots or more. And, 10 lots, it's not a huge amount, but it's already something. Then when you trade in liquid conditions and assets, the volume weighted average price, the VWAP for say 100 lots, for a trader to place 10 million trade in the market is something like a 0.5 weighted average slippage. So if you trade at say 0.0 spread or at the top of book, which is good for 10 lots or more, and you've got say up to 10 million going to the market right after you can roughly count on a slippage of something like 0.5 pips for your investors. That's kind of the rule of thumb. That should be good for most Darwins. I mean, there's very, very few Darwins right now that trade more than 10 million at a time in the market. Okay. With that understood, I'm going to now start explaining the implications of last look and liquidity provider aggregation, which is how you place those 10 million in the market. So basically, if I say, if THA is trying to place 10 million in the market, what happens at the other side of the fence where the liquidity providers, the LPs, are, and how do those 10 million get digested by liquidity providers? Okay, and as you'll understand, the way the market, so Marcus asking me 10 plus lots means up to, so 10 lots means about a million of nominal. Okay, so a lot is 100,000 of the base currency. So we're talking about, say, in the euro dollar, it would be like $1 million. 100 lots would be $10 million. And you can check when you go back to the interface, you can see how much volume each trade was on your Darwin. So for instance, in this case, we're talking about, say, 4 million, and there would be larger trades going here. The size of the values here shows you the actual amount for each order. So this would be 32 lots to give you a reference. Okay, understood, Marco. Apologies for the lack of clarification. So what I'm saying is the top of good is always good for 10 lots, and it could be good for up to 20 lots. That's at least that's how they pitch it. Okay, so what I'm saying is, as I said, don't blow things out of proportion. You know, the price investors get if you're trading less than $1 million per trade is the same that you get. If you get to a point where you're trading 10 million size under normal market conditions, the market slippage would be something like 0.5 pips or less. But we're now talking about what will happen when the biggest Darwin providers start trading more than 10 millions a clip. Okay, that's kind of we're looking ahead of what will come in the Darwin future. This is not to do with THA or any of today's Darwins. I'm thinking of like 1 year, 2 years from now, and I'm starting to educate Darwin providers so that hopefully they start thinking of success defined as managing 10 million AUM instead of 1 or 2, because that's where we're headed with the current growth. Okay, are we understood? So I don't want anyone to panic saying, oh, you know, Darwin is fucked because the market is going to go against us. It's not. We have plenty of time to prepare for this, but nevertheless, I'm doing this to try and educate Darwin providers the way a hedge fund manager would think. That's what this webinar is about. Okay. So again, we did this webinar explaining how liquidity works. If you want to read up on that, that could be also interesting. We'll touch up on some topics today on that, but if you want some more background, I encourage you to watch this one. Again, I'm pitching this at the level of a Darwin provider who's been in the market for several years now and is now looking at a couple of million of assets under management and is thinking of optimizing his capacity. So I cannot go about teaching this at a lower level because my target audience today is THA, VTJ, LVS, and so on. Everybody else is welcome, but this is what this webinar is for. Okay, now think of yourself as a market maker that makes prices for all his customers exclusively. So he's not competing with anyone else to gain flow, but instead it's captive flow that can only trade through them. So this is what, say, the market, you know, the guy managing the dealing book at, you know, say Swissquote or IG or any other good market maker. Okay, so what are those guys thinking? Okay, so what they do is try and capture more revenue than they would by just hedging booking all the flow. So the bottom line we've got here, this is, by the way, drawn from IG, which is a company I hugely respect, and they compare three possible business models. The lower bar is what the revenue IG would be making if it hedged all its exposure with third parties. In other words, if it didn't make markets, that's the money they would make. Now, the blue line is the revenue that IG would make if it made markets for all its customers. And the line in the middle is the revenue that IG actually made, because what IG does is say, okay, whenever my flow is random, that is, whenever all my customers are, say, trading randomly for the euro dollar, what happens is that, say, you know, trader A goes long the euro dollar, 3 seconds later, trader B goes short the euro dollar for the same amount that trader A took. And that way, what the maker does is keep the spread 2 times without actually taking any euro dollar position. Now that's free money, because what happens there is the top line here, where you're getting paid the spread as many times as people are trading against each other, and you're not risking anything. You're not actually taking a position, which is what liquidity providers don't want. That happens when the market moves sideways, and all you do is basically, you know, make free money because customers are providing liquidity to each other and you don't have to put your balance sheet at risk to do so. Now, what happens when you've got a market that is going with a strong trend? Whenever the market goes with a strong trend, what happens is the winning customers double up, the losing customers get kicked out of positions, and all of a sudden what happens is the entire customer book is going one direction. So for instance, you could have all the customers for IG are now long the euro dollar. Or we could even look at, I mean, if any one of you guys remembers the flash crash around the first week of October 16, what happens then is that, for instance, and if you're familiar with DWC, I encourage you to watch that. So this one tracks the positioning of the customer book at Darwin X, and we use this as an instrument to hedge ourselves, which basically means we trade the same way that our market provider would trade. Now, when all customers are, say, long the euro dollar, that means too much risk for the market maker. And what the market maker then does is hedge, which is it covers its risk, but it comes at a cost because it has to find another broker to place the position with. Okay, so that's whenever all customers are facing the same way, then what IG does is hedge the risk and forgo the difference between the blue line and the dark blue line. This is the cost that IG faces for hedging, but in exchange for that, they reduce the risk they run with their book. Okay, that's how a liquidity provider thinks. Okay, any questions on this so far? One way to think about it is, I want you to think of a poker game that you're playing. Okay, you're playing a poker game, and it's a poker game of 3 people. It's a poker game with the world's best poker player and a sucker that you've just met. So whose bet would you rather take? The world's best poker player poker player in the, or the sucker at the table? So you'll very likely not want to be against the good player because he knows, he's very likely going to get you, whereas the losing one won't be. So the decision is, what you do is do not play against the good guy, but by all means play against the guy that you know is worse than you because you're bound to win. That's what liquidity providers do in this case, if they're not competing with anyone else. Okay. And now we get to something else, which is the nature of liquidity aggregation. Now, I want you to think of, I need you to think right now of, put yourself in the shoes of a liquidity provider. Okay, you think that you're, say, JP Morgan, and your current appetite now for euro dollar, long or short, is X. So your balance sheet allows you to take up to, say, 100 million or whatever it is, 20 million of risk. That is X. Now, you stream liquidity onto multiple prime brokers. So you stream liquidity onto, say, Saxo, you stream liquidity onto IS Prime, a whole bunch of other names that are out there. These are retail aggregators that publish the ultimate price that JP Morgan just published. Now, the issue is, which is not unlike airlines overbooking, is that you know that if you want to get X worth of exposure, because it's not going to get hit at all venues at the same time, you can afford to publish more exposure than you're actually willing to take. So that's why you would publish, I'm willing to take 0.5 of X with Saxo, 0.5 with Sukden, and a bunch of others for a total that adds more than X. Why? Well, because you want to get to X, and for you to sell X, you have to place it with multiple venues at the same time, knowing that some of it will not get taken. And then, of course, those venues cater to the needs of brokers like Darwin X. So, say broker 1 would be Darwin X, broker 2 is, say, Swissquote, and a bunch of other retail brokers here, who are all receiving stream prices via multiple prime brokers, which gives you the illusion that there is a lot of liquidity available. But actually what happens is you've got this a finite amount of liquidity that is being streamed to you from multiple venues at the same time. This is some sort of liquidity illusion here. And then put yourself in the shoes of X when the super duper EA, which is sold all across Europe, America, Latin America, Asia, and beyond, and there's 16,000 people who choose to trade a signal by that EA at the precise moment when that EA triggers. Okay, so what happens is at that point, then all the liquidity that's offered by JP Morgan and all the others is going to be challenged. And of course, the liquidity providers have algorithms to protect themselves in these events. So what they do, and that is called last look, what they do is say, okay, well, I retain the right to renege on the price that I had offered. So if I said I'm going to take 5 million of Eurodollar through Saxo at this price and they get hit from all places at the same time, what they basically do is say, okay, well then, no, sorry, I'm not going to take all that much volume anymore. That's what last look amounts to. Okay, and at that point, what happens is very high artificial slippage because, of course, the price that the EA thought it was going to get, it actually gets whacked and slipped downwards out of all proportion, because basically the algos that make prices for JP Morgan go into panic protection mode. Okay, does that make sense? So basically, the liquidity that you see, for instance, is right now, like the liquidity you see, say through, I'm not going to put LMAX into this box because LMAX is different, but the liquidity that say Saxo is streaming right now onto the market that you see here, this volume that you see is double booked because it's being offered by the same liquidity providers that fill this book, also fill the IS Prime book, and they fill the Sukden book and the other retail aggregators that you tap indirectly when you're trading through retail FX brokers. So the liquidity you see here is double counted. It isn't as much as, I mean, it is true provided that not the super duper doesn't hit right now from all places at the same time, because at that point what's going to happen is it will fade and you will get down to the actual real liquidity. Okay, questions so far, guys? I know this is difficult, but I can only understand your questions if you place them. So please, I'm just going to give you 1 or 2 minutes to reflect on this. It's not easy. It's not easy to understand. It's not easy to explain, but I'm here to do my very, very best and try and make it understood by you guys. Okay, so I'll try and repeat and basically say, okay, the super duper EA has triggered on a certain market price, and you think you're going to get the normal slippage, which is as defined by the VWAP. So you go into the market right now, you go, the volume weighted average price is at the top of book, it's going to be 0.1, 0.2. But then if you go up to up to 10 million, it is going to worsen by 0.4. That's the difference between 0.6 and 0.2. Now, what happens is if an EA now triggers hoping to place 10 million with Saxo and 10 million with I'll say it, with say IS Prime and a bunch of others, what happens is the liquidity is double counted, therefore the slippage is going to be bigger than you see here. And that, for instance, is one of the reasons why it's bad to market your EA with multiple providers at the same time. Okay, so we've discussed what happens with the liquidity providers, and now I'm going to explain, to show you the world from their view. So how does a liquidity provider feeding prices into Darwin X via Saxo see the world? Well, what they see is they are feeding prices through Saxo and a bunch of others onto multiple customers, and Saxo will monitor the decay pattern by Darwin X flow. And I'm going to explain what decay means. So at the point 0, which is when Darwin X places a trade, the liquidity provider hopes to make something like 25, I mean, this would be two liquidity providers, but hopes to make something like $25 or $30 per million, which is 0.3 pips. That's kind of the average spread, say, on the euro dollar. When they price that, they have a safety margin of 0.3 pips that they hope to keep by market making. And then, of course, as time goes by, and time is here like 1 second, 5 seconds, 30 seconds, 60 seconds, what happens is that if the market moves against, like for Darwin X and against the liquidity provider, then the liquidity provider finds themselves with a hot potato they had to get rid of as soon as possible because the P&L is fading fast and they cannot offload the risk to keep the profit they thought they were going to make. So the faster this line slopes down, the more toxic Darwin X flow is to the LP, and the wider they will therefore try to price us. Okay, so Marco's asking me, did we think about using futures markets as a hedge liquidity source? And the answer is resoundingly yes. That's one of the reasons why Darwin X is working hard to go into the futures market, because for a number of reasons, there's more market depth there, and moreover, the markets are more robust when it comes to futures. So one way to mitigate or to increase capacity for Darwin's will be to try and tap the futures market first, and only go to the OTC retail FX market if we must. But that's like a couple of years project. Okay, so we are aware of this, but for now, I need people to understand the poker game they're playing, which is essentially this, right? So it's a game about, from the standpoint of the liquidity provider, what they want to do is make no less than the spread, and perhaps, up to the point where they've managed to hedge the flow in 30 seconds, they would like the curve to be upward sloping, which means, okay, not only did I make the spread, I have actually captured more than just the spread, because the customers tended to go in at the wrong time. But as it is, because everyone at Darwin X is crowdsourcing information to time trades perfectly, we will over time become more and more toxic by pooling more and more capital on the traders that time the market best. Which is another way of saying we will become an increasingly better player at the casino, and eventually the casino will not want us in it. Okay, so this is how a market maker sees the world. So they think, okay, how much money, how much of what portion of the spread can I capture in for what period of time? And what this is saying, for instance, in this case, the dark blue line is saying that, okay, at the point where Darwin X trades, there's still 0.3 pips to be made in the spread. But 1 second later, this is pretty much all but gone to something like $5 per million. And a bit later, it's gone. So Darwin X is a dangerous party to trade against. And therefore, the only way to do that is either stop pricing Darwin X or price Darwin X more widely, so that we basically shift all this curve, say, up to half a pip up, so that they have a safety margin for them. That's kind of the way they're seeing it. And that's actually the way they look at it, because what happens is if we make too much money from spread decay very quickly, then we will be put on we'll be taken away from the best feed, which is the tightest, the one with the lowest spread, and they will put us on feed which is wider to protect themselves from the eventuality that we make that we, instead of them, capture the spread before they can hedge out with the rest of the market. Which is why it's important for the likes of THA and other successful EA providers to ask themselves where they want to market their strategies, because if you market it at multiple places at the same time, you're going to compound your liquidity problem, because an LP, once it gets hit with a big trade, it needs time to find a way to hedge it before it has generated market impact. So if you're going to pass a hot potato to the guy, to the LP, you might as well give them time to place the hot potato first before you break the news that a great trader just traded. Okay, the liquidity providers, they need first mover advantage to hedge with less impact. Okay, so there's a good point here that I'm being asked, but I still want to finalize the point here, Marco. I'll come back to that in a second. what goes on in the market is there's some sort of adverse selection. So the suckers who tend to lose get a better price than the ones who tend to win. Think about it that way. So if you have a guy who's guaranteed to lose regardless of the spread, you can give him 0.0 spread on the euro dollar because he's going to lose anyways. So you might as well get that guy to lose with you. It's the game about attracting the suckers with the tightest spreads. But of course, if you have too tight spreads, then you're going to attract winners who will make the spread from you. So you have to find a way to segment trader quality, whereby you go, okay, the suckers get 0.0 spread in the euro dollar, the good traders get 0.5 because otherwise they win. And this brings me to the eventual Darwin X future, which is a feed for traders, which will be the last look spread feed. Where you get a certain price because you're a sucker. That's kind of the retail flow, and there will be another price for Darwin investors because unfortunately they will price us wider on the winning flow. And of course, because we're both a broker that caters to traders and an asset manager to cater to investors, we will do our very best to offer the best conditions to both, which will mean we will have to segment the flow ourselves by offering very good cosmetically good spreads for the people that lose and go for the broader market in, say, the futures market, as Marco is saying, for the investors that are winning. Again, this is not something that has happened yet, but I'm now thinking of 2-3 years into the future when Darwin X has grown to be the world's biggest crowdsourced hedge fund, and we face these sort of issues. I'm just trying to educate everybody to understand the game that's going on. It's not like we have this issue now, and I don't know when we will have it, but if we grow, the price of success will be this. Okay, so takeaways. So how can you improve your own capacity? Well, you have to start planning for this and try and build structurally scalable strategies. In other words, try and trade pips. So go for 100 pip P&L per trade instead of a 5 pip P&L per trade that you gear up 20 to 1, because the more the leverage has a price, and that is capacity. Where possible, try and avoid illiquid market situations. And for instance, I mean, anecdotally, and this one is an easy one to fix, all EAs trigger, evaluate the price in set intervals. For instance, at the 0.0 second in a minute, which means EAs are far more likely to trade in the first second in a minute than throughout that minute. So if you have an EA, program it to trade in the middle of the minute instead of at 0.0 second, because that way you avoid the congestion when everybody's trading at the same time. It's silly things like that. Then of course, centralize your PAM or EA execution ideally with Darwin X. So the likes, I'm happy to see that, for instance, the likes of LVS that you can see here. If you came here a couple of months ago, they were offering the services in MyFX Book with multiple brokers, and they eventually chose to centralize everything with us, not least because it improves the execution, and also they don't have issues with credit card chargebacks by selling EAs or customers that basically require attention and so on and so forth. We handle all that for them, and we can also optimize the execution better than them if they centralize the execution with a single broker. Okay, so, and we know we have work to do, more on that later, for us to deserve that confidence, but I think everybody is better off when that happens, because if you go, for instance, for say JMC, which is a pretty good Darwin that unfortunately suffers from atrocious divergence, because this is an EA that is sold commercially with multiple brokers at the same time, and what happens is it doesn't get nearly as much capital allocation from through Darwin X than it could get on account of the divergence. And then last but not least, if you must, ultimately you'll be able to break up your trades into smaller fractions to try and minimize the slippage, but only do so once you start seeing that you really get hit through divergence, not before, because otherwise you're incurring into latency, and that's going to distort your performance. Okay, any explicit questions on these practical pieces of advice? Okay, so ultimately, if I had to give you like one phrase to remember is when you're building an algo, optimize it for the real ocean, the real market, the prices you see in the futures market. Don't optimize it for the fishbowl because the prices we offer are cosmetically close, the artificially tight spreads, which we only get because a lot of our traders are retail traders who lose money. But once we build up the professionality in our venue, then will tend to win. And unfortunately, the market will the OTC last look markets will price us out. They will price us on wider spreads than we have today. Okay, so Isaac, how close together do these fraction trades have to be without confusing the attributes for the Darwin? Um, okay, I'll come. Let me come back to that on this one. Okay, because that also has to do with Darwin X. So how will we improve Darwin capacity? So we are already working on removing the trade replica latency. So this lead trade replica trade setup, we will we're working to get rid of it as soon as we can. I cannot give you timelines, but we're fully aware that that's something that has to go when we go forward. Now, we will try and make more order types available where these are genuinely supported by the venues. For instance, I know that THA has rightly requested fill or kill orders to be added to the arsenal. This is not something that MT4 supports out of the box, but we're looking into ways in collaboration with our bridge providers to make those order types available. So we will try and make more order types available, such as including fill or kill, but also including limit orders, which are generally placed directly into, say, the LMAX order book, where they're not going to be run, where the stops will not be run. Okay. Then, and this is more of a philosophical debate that I want to share with you guys. We will somehow need to price for capacity saturation. So it is extremely inefficient for Darwin investors, Darwin eggs, and DHA to have to shut down DHA for new investment. So it's not something that anyone wants. And the fact is, maybe not in the case of DHA because they trade the news and every second counts them. But for instance, with VTJ, trading exactly alongside in the same second that VTJ trades carries a slippage penalty because you're saturating the capacity at that very point in time if we send everything in a single block. But 2 seconds later, then the liquidity is back up, and then you could place some more volume. So, for instance, imagine an EA that traded whatever it is that VTJ traded, but always 2 seconds later. Well, maybe that EA, if VTJ is not that time sensitive, would make more money by saving the slippage. Okay, and then it is beneficial to everybody if we had, say, a Darwin API and API traders who basically build these sort of Darwin execution optimization algorithms on top of the root Darwin order. Okay, so we're thinking of ways to prioritize traders of Darwin's or algorithmic traders trading a Darwin API over passive investors who consume liquidity. And we have some ideas going around, which I cannot really share right now, but it's all designed kind of traders first. How do we make sure that a Darwin provider makes the most of people who are using his signal, accounting for the fact that signals have limited capacity? Okay, so that's something that's going on, and we're fully aware that closing down and Darwin for new investment amounts to setting an infinite price for a new investor to join, and that is inefficient for everyone involved. Okay, so that's kind of an issue we know we will fix over time. It's not obvious how to do it, but we're aware of it. And this comes back to Isaac questions before. How close together do these fraction trades have to be without confusing the attributes of the Darwin? So we will, over time, we will give managers full control over the execution of the Darwins. So Isaac, basically what will happen will be that you will have your own EA, you will have EA A, which is the market timing EA, which will say, okay, given that I've got 20 million of AUM tracking me, I'm going to enter the market now. and then we will give you tools to build execution algos so that you can break up the 20 million in fractions that minimize the slippage that you're going to get. So from the standpoint of today's algos, what will happen is Isaac has placed a single trade for 20 million now, and then there will be a second subset of algos which will optimize the execution for that, so that you can maximize the capacity of your Darwin without confusing the algos. Did that answer your question, Isaac? Did that make sense? So for the time being, actually, you should not worry about confusing the other algos through this, because you won't. Okay. So I'm going to read through some questions that I have in here. So Mark is asking, is there an incentive to use limit instead of market orders, since limit orders will tend to be filled counter trend, so less slippage? Okay. So Mark, this goes back to the asymmetries that you face today as a retail trader. As a retail trader today, trading through MT4, you can only take liquidity, which is send market orders, but you cannot make liquidity, which is send limit orders that get filled in order book. Okay, so you're basically you can only run where others can. So you can only walk where others can run. Now, obviously, a long-term goal is for us to become our own venue, one venue where everybody can take liquidity but also make liquidity. And conceptually, somebody who is making liquidity is delivering a service to the marketplace and therefore should not pay the same amount of commissions. So conceivably, maybe we could charge a commission to people for people who take liquidity, but we could basically waive the commission for people who make liquidity through limit orders. Okay, and then when it comes to any timeline on when limit orders might come, so we're looking right now at the order types supported by both the trading platform and the venue. So right now the sequence is you trade on MT4, it goes to a bridge provider, which is currently PrimeXM, and then PrimeXM passes that on to either LMAX or Saxo. So we need to find a way to make sure that if you choose to only trade on LMAX, you basically get access to the full suite of orders that LMAX supports, which you will trigger indirectly via the MT4 or the bridge. So that's kind of what we're looking at. If the MT5, which we'll be adding very shortly, and the bridge supported, then we will do our very best to enable all the order types. And maybe one way to bypass that issue would be to trade directly through a fixed API onto the bridge and overcome any limitations that MT4 might have. And we can discuss that because fixed connectors are free. Okay, so that was that. I mean, today this was it was pretty abstract. I apologize for that, but if you've been around for long enough, hopefully this should have made some sense. If it didn't, I apologize, and I would be very grateful for feedback on stuff that you really didn't get, and I'll do my very best to improve for the next iteration. This will be recorded on YouTube, so that, I mean, maybe there's some stuff in here which you'll only get by hearing it 2 or 3 times. Maybe that makes sense. Okay, so I've got some clever questions here coming in as well from Mark. So, okay, now if execution gets optimized, should all investors get the same weighted fills as the block trading? Well, that's a very good question. So the issue here is right now, think of a crowded bus. Okay, so think of a bus. Darwin as a bus. The first investor comes in when the bus is empty and it's pretty comfortable. There's no slippage. As more people join the bus, then because we are allocating the same weighted average price to all investors, what happens is the new investor, the marginal investor, is benefiting from investing in the Darwin at the expense of the investor who first backed the Darwin back when he wasn't popular. And this is counterproductive because it's encouraging latecomers over visionaries in the Darwin. So this is one of the things we need to account for when rationing for scarce capacity. So The answer is no, Mark. We will over time need to find ways to prioritize investors who bring more value to the table than others. For instance, a trader of traders brings more value to the table by optimizing on top of an existing EA than a passive investor who basically sits there and just waits for THA to place the trade on his behalf. And that we need to align incentives to bring everything full circle. So no, over time we will do away with this setup where all investors get the same price, and we will need to find a way which is aligned with a trader's first vision to make sure that the ones who contribute the most to the trader get better treatment than the ones who do less, because ultimately capacity is what it is, and you need to make the most of it. Well, that was a long sentence, but I hope that made sense. Okay. Any more points that you want to raise? I mean, I put these points in here basically describing why an exchange is better than the last look, but I guess this should be obvious by now. That's the reason why we hang on to LMAX as a liquidity provider, in addition to another last look provider when we aggregate liquidity. All right, so yeah, unless you guys have more questions, you're either brain dead by now or you've understood everything that I said. So I think it's probably time for me to thank you guys for being around and to call it a day, unless anything comes up. As I said, we will upload this onto the YouTube channel, and we look forward to any questions on the YouTube that we can share with everyone else. Okay. Thank you, guys. Okay, so Isaac is asking us, one webinar we said we are working on improving the spreads. Is there anything coming up anytime soon? If you can clarify what you mean by improving the spreads, I'll be able to give you a better answer. So as it stands now, I don't think there's much we can do to improve our average spreads. I do think there's things we can do to try and make price spikes less likely, and we are working on that. We haven't come to a final conclusion because there's an operational challenge involved in implementing the solutions we've identified, but it's something that will happen as soon as we launch MT5 in the coming weeks and add a single stock CFDs, which are the two next things on the pipeline. Okay, Sadiq is making a very good point here. So big hedge fund managers have to reinvest 25 up to 50% of the performance fee to their fund. Why is it not the case in Darwin's? That's a very good point. So what we do right now is disclose the trader equity in any given Darwin. So that way you know how much equity that the trader has in his own, well, how much skin the trader has in his own game. Now, if we feel that incentives are not sufficiently aligned, we will consider in the future options to force or incentivize the traders to reinvest their own equity as a proof of commitment. So that is a question for the future. We don't have plans for that just yet, other than being fully transparent as we already are. Yeah, on swap rates, we are working with our the liquidity providers. I cannot give you timelines because these conversations take time, but we are aware that we can improve our swaps, and we will do our very best to get there. I mean, just so you know, we are not marking up the swap, so we pass on the swaps that we get. Right? This is not as though we're increasing that margin there. Okay, this is a very good point that Alexandra has made. I'll read this point aloud for everyone to opine. So I said, you as in Juan said, IG is a company I respect a lot. However, in my experience with them, they are clear market makers and benefit from the position to the expense of traders. Since the basis of Darwinex is not being a market maker, I was wondering why you approved of them. Thanks. Okay, very good point, Alexandros. So this one has taken me years for me to understand what's wrong with market makers. Okay, and I really encourage you to watch the webinar I did on DWC, which I think I've referenced in this one. Now, the problem with a market maker is not that he trades against you. Why is that? Well, because you need somebody to trade against you. If there's no one to trade against you, you get back to the situation of the whale, right? So if the whale, when does the whale situation happen? Well, when you want to buy Eurodollar and nobody wants to sell it to you. I'm just going to go back to the sequence here. Okay, did that sink in? So market making per se is not wrong. That's not the problem with market makers. The problem with market making in FX today is twofold. The first one is that if you're familiar with betting and what Betfair did to betting is with market making in FX today, the market maker has a right to be the house, and you as a player can only be a liquidity taker. So if you think that the odds offered to you by the house are not fair, you don't have the option to offer other participants better odds than that. You can either take the house's odds or you basically not play. So you're restricted to being a taker, but you cannot be a maker. That's one of the issues that's wrong with the markets today. Now, if you are forced to trade with a market maker, then you are better off with someone like IG than you are with a shithole in Cyprus or even unregulated. So if you're going to go with a market maker, you're better off going with IG. If you're going to go with a market maker, you might as well go with a big one because you know they will have a big balance sheet to pay out your wins if you're going to make money. And last but not least, IG have been around since 1977 in an industry which is full of liars, deceivers, crooks, and other scumbags. If they have been around for 41 years, there's got to be a bunch of things they're doing right. And if you look at their investor disclosure, you'll see there are customers who have been with them for more than 5 years. So they can't be all that bad. And I have a lot more good things to say about IG than I have around other Cyprus-based outfits. Let me put it that way. So that's kind of how I qualified my statement on them. Okay, so there's another good point by Sadiq. So, are we planning a meeting in Darwin X head office so investors might come and meet with you and the Darwin managers? So, we are acutely aware that the more an investor knows about a manager, the easier it is to build trust. And right now, one of the issues that I feel we have with the platform is that it's too anonymized. You don't get to touch the person that's behind the Darwin. So that's the reason why we do the interviews in the blog and why we also do webinars. And we plan to expand on that, hopefully with the collaboration of the managers. When it comes to face-to-face meetings, that's a good idea. I hadn't thought about it, quite frankly. At this point, we don't really have that many large investors in Darwin's. As it is right now, the issue we've got is that Darwin investors are growing faster than the stock of traders, although the stock of traders is growing fast as well, which is good news. So we are not really keen to we'd much rather have traders of Darwin's who learn to make the most of the Darwin asset class without saturating than we are to attract large investors who want offline meetings. Not sure that made sense, but that's our policy for now. But we are acutely aware, Sadiq, that we can do more in terms of disclosing about the strategies and presenting making the Darwin providers more approachable, and we will work on it. Okay. So I've got a question by Isaac. What do I think about Oanda? The API is very nice. Would be nice to have something similar for Darwin X. I think Oanda's API is indeed very nice, and we are working towards offering our own API. Unfortunately, that all takes development resources, and we're chock-a-block right now, just handling with growth. But Oanda, I mean, the API is nice. I'm not sure about the prices. I think we're far more competitive price-wise than Oanda is. But I'm not familiar with them because I don't compare them all that often. Okay. Any more points? I mean, if there's one thing I could ask from you guys today is, I'd be very keen to understand, to have you answer for two questions. So one is, how did you first hear about Darwin X? And question two is, if there's one thing that I could give you right now as an improvement in Darwin X, what would it be? If you could answer those two questions for me, I would be super grateful, because that's the only way for us to learn, to please our existing customers and to know where to find more customers. So please, 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 if you can take just 5 seconds now to type that into the question box, that would be super useful. Okay, a custom start date. That's an interesting one. What do you mean, Liam? I'm not. What is that? Okay. Okay, so on trading equities, we have good news coming on that. So I'm not going to promise timelines, but we have good news coming on that pretty soon as well. Okay. Good stuff. So, I mean, just so you know, basically, the way Darwin X grows is through you guys. We cannot advertise we cannot afford to advertise because we don't make money from customers losing, and therefore we cannot, basically go out and do banners left, right, and center. So our only way to grow this movement is you guys. So if you know somebody that you like and you would like us to deliver on functionality faster, that costs developers, and unfortunately the only way to pay for developers is with more customers. So it's as simple as that. So your way to get the roundabout way to get us to deliver an API and equities and all the rest of it is for you to tell your friends that you don't always have to trade with a shit broker. There's other things, but unfortunately they don't get advertised. They only get referred. Okay. Um, Fantastic, guys. Okay, so Sadiq, when it comes to divergence, we have done I've done my very best today to explain the bits that can be fixed about divergence, but you should also acknowledge that there are bits about divergence which cannot be fixed, and we will just have to live with it. So ultimately, it's a bit like that. So good Darwins are a bit like hot chicks, right? You have to go and get them before somebody else does. That's kind of it's as sad as that, but that's the way the world works. Okay, so Giovanni is asking, why are we not offering introducing brokers? Well, the regulation about, to introduce customers onto a broker by way of business is a regulated activity, and people who do that should be regulated to be able to do that by way of business. If they are not regulated, they are in trouble, and ultimately Darwinex could be in trouble. And we have decided to, for the time being, terminate the existing IB setup, but we've got something else in the oven cooking that will come pretty soon, and that one will not be subject to regulation. Okay, so Liam, this thing with I would like to start from then, like MyFXBook. I'm not familiar with MyFXBook, so I'm sorry, but I don't really get what you mean. And I'm sure it's a pretty good feature, so I'd be very keen to understand. Apologies for that. Thank you guys for all the kind words. I mean, it's tough to build a startup, and I really appreciate the kind words. So, okay, so Mark is asking, you strongly believe we should give more emphasis on the portfolio side, which feels finally left out. Ability to manage multiple portfolios concurrently, better interface. Okay, so let me explain that. So we need to find a way to manage the capacity situation, because if we don't find a way to manage the capacity situation, and you cannot put THA into your portfolio, then your portfolio functionality is going to be useless. So we need to. I agree. We need to do that, but we have finite resources and we need to tackle the problems in the right order. And unfortunately, portfolio capacities, much as I'd love them, we need to fix the capacity first. Richard asked, do we get links to invite friends to our Darwin? And the answer is yes. So that the best way to get people to come to your Darwin is to use the Darwin widgets that you can put on your website, and they come with links as well, so that people can come to DarwinX with it. But Mark, we've talked about this. We are fully aware that we have usability issues with the current interface, and we are working on that. But unfortunately, Jesus, there's 50 of us now at DarwinX, and everything always takes longer and longer and longer. Okay. Good stuff, guys. These Q&As and these conversations mean the world to us. So if you want more of these, we can always try and find ways to do more Q&As. Okay. So RWL Darwin. So yes, Sadiq, others have already requested alerts when, say, a Darwin goes inactive for some time and so on. So that's something we're also looking into. We're trying to build an alert system for investors. Having said that, guys, right now people pile into, say, VTJ and LVS and all the guys which have like a kind of very, very smooth equity curve, but there are equally good traders out there who have ridiculous amounts of investment considering the returns they have done over multiple years. So I strongly encourage you to explore beyond what the crowd goes for, because there are hidden gems, more and more coming every week to DarwinX, and if you pay attention to the stuff, you can be early in some very, very good opportunities. So I really encourage you to basically build your own filters. Don't go for the default filters where all the lazy investment goes. Go for the stuff where you've put in the proper research, and there are far more good traders than people realize. Okay, the two-factor authentication, that's something we're looking into, Mark. So that's, as more and more money comes in, there's that, plus also a deposit guarantee in excess of the 50,000 FSCS guarantee. So we're looking into stuff like that as well. Okay, guys, it's been a real pleasure to enjoy 1 hour of your company. It looks like we've really run out of out of time, but it's a real pleasure, and keep the suggestions coming. So Liam, I'm still at a loss on the start date thing. If you guys want, please email me on that email address. I'm not going to publish this one because I get hammered with random spam, but if you've spent 1 hour listening to us, you can email me whenever you want. Take care, guys. Always a pleasure, and speak for the next one. Bye-bye.